Are you overwhelmed by the flood of real estate syndication options? Seems like every turn there's another deal, each promising the same thing, the same exceptional returns, but they all look the same. So how do you decide which one is the best? Hi, I'm Dr. Jeff Anzalone, a periodontist and also somebody that's been investing in syndications for over 8 years who understands this frustration firsthand. And in this video, I'm here today to help navigate you through the complex maze of real estate syndications and to make your investment journey as smooth and as efficient and rewarding as possible. If you're new here, do me a favor, download the free passive income guide with the link below this video. Now, one of the most common questions new members of our group, the Passive Investor Circle, I'll put a link below this video, they ask me is, Jeff, how do you tell if a real estate syndication deal is good or not? Well, that's a pretty honorable question there, because I can tell you that if you've ever thought this or asked this question, you're not alone. You're not alone in feeling swamped by all the different choices that are out there. In fact, it's actually a common predicament for many people that are out there. They're practicing, whether they're a dentist, doctor, attorney, whatever, busy professionals. It's not a common predicament to have very little time to really dig deep into each deal to determine the best one to choose, okay? And do you know what happens in life in general when there's just too many choices? Nothing. That's right, nothing. People don't do anything whenever there's just too many choices because it's confusion. And whenever they're confused, then they have all these things to look at. Then they slide into analysis paralysis, and then nothing changes in their life, which is just a cycle. It causes even more frustration. Let's change that today. I want to equip you with the tools to cut through the noise and make clear, confident decisions. I want you to think of this video as your personal GPS for navigating the world of real estate syndications. And with this guidance, you're going to be able to quickly identify which opportunities are going to align with your goals, because it's personal finance. It's personal, right? And more importantly, which of these deals to pass on. So let's get started first by demystifying what a real estate syndication is, because not really sure if you are a beginner, expert, whatever. So we're going to just start with the basics. So what are real estate syndications? Let me get this very, very basic concept down for you. All right. So real estate syndications, you have a general partner, also called a GP. These are the people that go out, they find the deals, they underwrite the deals, they tell if a deal is good or not, they get the financing, they pretty much do everything, property management, they keep the property leased, if they want to sell it, whatever. So they handle all the day-to-day operations. That's the general partners, all right? Then you have limited partners. These are the limited partners are the passive investors. The only thing that they bring into the deal is the capital. They fund the deal, and then they, in return, are rewarded because they get typically a quarterly or monthly distribution, aka passive income. And then when the deal sells, not only do they get a bunch of tax advantages like depreciation, accelerated depreciation, that sort of thing, but they also get their original investment back plus whatever the profit split is, okay? So the general partners and the limited partners come together, they form an LLC, and then the LLC holds the property, okay? That's a very basic 40,000 foot view, okay? So syndications basically allow you, especially if you're busy like me, they allow you to invest in significant real estate ventures like big 3, 4, 500 complex apartments or mobile home parks, RV parks, self-storage, these huge real estate ventures, while sidestepping the day-to-day hassles of all the property management. Because again, the general partners, they're the ones that are doing it. It's kind of like owning a share like in a top tier company without the need to be involved in the day-to-day operations. However, it's not just about owning a share of this LLC. It's also about smart ownership, because think about it, you want your investment to grow. You want it to be secure. And again, you want it to align with your long-term goals. That is where the real challenge lies. So here is the million-dollar question. Jeff, how do you pick the best deal? How do you know if a syndication that you're looking at all the numbers, how do you know if that one is the best for you? Now, this process isn't as straightforward as just looking at the numbers, looking at the projected returns, or looking at pictures of the property, the aesthetics of the property. There are several layers to this, okay, that can either make or break your investment. So now let's tackle the main challenge, distinguishing one syndication from another, because it's very critical to understand that not all deals are created equal, even if they look similar on paper. Okay, if they all have the same numbers, the same returns, they kind of even look the same. But again, not all deals are created equal. This is where a keen eye and this framework I'm going to give you today come into play, okay? Number one, it is the most important thing. Remember we talked about the general partners over here or the management team? The first thing you want to do is consider and figure out their track record, okay? That's why I listed it number one. That is the number one thing. So it's kind of like choosing a pilot for your flight. You're going to want somebody that's experienced and skilled at the helm, right? So for the general partners, you want to investigate their past projects, their success rates, and how they've navigated challenges. So a strong, reliable team basically can be the difference between a smooth journey or a turbulent one, just like on a flight. Again, in my opinion, this is the most important part of the puzzle. So if let's say I like to snow ski, okay? So let's say I'm out in Colorado or Montana or something. I'm skiing down, I twist my knee, I hear a pop. I literally can't put any weight on it. Maybe that's our first day of skiing. So I don't want to go home. My family's still there. I don't want to ruin the trip for them. So I've got to go find a good knee guy. Well, how am I going to do that? There's a process that you're going to go through. Maybe you're going to talk to people at the ski resort or talk to other doctors in the area. You're going to look online. You're going to maybe look in social media, whatever. You're going to figure out a process, a way to do that. So just like when you're doing looking at the track record, there's a process. You need to do everything that you can. Ask other investors. Look at their social media profile. Look at their website. Look at, do they have reviews? There's all kinds of different things that you can use. Okay. Again, I cannot stress the importance of the track record of the general partner. All right. Now let's talk about number two, and that is this: location and potential. Location and potential. Real estate is about where as it is about what. A property in a thriving area with growth potential is like a seed planted in fertile soil. You need to explore the local market trends, future development plans, and economic indicators. It's not just about the current state, but the future prospects of the area. That's why we talk about the location, not only the location now, but the potential that the location has, okay? Number three, another critical aspect is, and something that I have a lot of a personal experience with, and I'll share a quick story with you in just a second, is number three, the property, the building or whatever deal that you're going to get into. You need to look at the property's overall tenant profile. All right, the tenant profile, the tenants that are the properties, that's going to be your income source, right? So it's vital to know who's renting. You're going to be provided a rent roll, or your syndicator, the general partners, they should provide that, or they should kind of provide an overview of the profile. Are they reliable? What's the vacancy rate like? A property with high quality long-term tenants is like buying a business with a loyal customer base. Very, very important. So when I initially started investing in syndications, I did what's called crowdfunding. That's where you go online and you can kind of look at the property profile and on all the numbers. I didn't know what the numbers meant. I actually wrote an article about it. If you want to check it out, it's basically how I lost $50,000 in real estate. And looking back, I had no business investing in real estate. I was just looking at the pictures. Oh yeah, this one looks good. And this one had the highest numbers. Didn't even know what the numbers meant. So I invested 50 grand in an apartment complex, Tulsa, Oklahoma, and did not know, number one, you're not able to connect with the sponsors. Well, at least you didn't back then. I don't know how it is now, because only time that I invest in these now is I go meet with the general partners. I look at their property. I'm very, very involved, because now it's not only on me, but it's for the over 2,500 members I have in my investor circle. So my reputation is big time on the line. Way more back then because it was just me. But anyway, the general partners in this group, in this Tulsa deal, they went into this very high crime area and they found this apartment building and everybody was moving out. And they didn't disclose this to us. But had I gone to the place and seen it in the neighborhood, of course I wouldn't have invested in it. So they got the big idea that they could throw a bunch of money into an apartment complex that everybody's leaving, fix it up, and people would magically move back. Guess what? It didn't work. They ran out of money. The general partner skipped town, and every limited partner, and it was a $50,000 minimum, every limited partner lost their money. Okay. So again, track record. Okay. Location of potential and the property's tenant profile. Those are the three main ways you can pick, or how you can pick good deal. So now that you're armed with this knowledge, you're not just you won't just look at a deal. You're actually going to see it. You're going to see beyond the numbers and the glossy brochures that they send you and all the fancy pictures. You're going to be able to start to see the potential risk and the rewards, and you'll be equipped to make an informed decision. Okay, so let's move on from theory to practice and see how this can work out with a specific example. Take RV parks. Okay, I want you to imagine two RV parks. You have one in Montana and you have one in, let's say, Biloxi, Mississippi. All right, so Montana. So the first part is located in my favorite state, Montana. And it's known for its fantastic, of course, if you've been there, for its fantastic summer weather and the scenic beauty, right? It's Montana. Here, whenever the person is marketing this, the investment allure is very clear. A seasonal boom that's going to draw a large crowd of vacationers during the summer months. Could be like they're going to Yellowstone, or they're going through all the different passes and looking at the mountains and all the different parks and all that. Okay, that's the investment allure. And then you'll look at it and the revenue spikes are impressive because of this. But again, it's just a seasonal play. Then for the rest of the year, for the winter, basically this part remains largely dormant, and because it's so cold and there's snow and all this stuff, and it's creating so basically this creates a pattern of feast or famine in terms of income. All right. So this scenario requires an investor to be comfortable with significant fluctuations in revenue and occupancy. All right. Number two park is in Biloxi, Mississippi, which we have a park there. So I'm very, and I used to live there. I did a residency there, and I'm very attuned to that area. So got the Montana park. Now I want to contrast this with another park. Again, it's in an area that's not bound by seasonal constraints. So this particular park is going to boast a diverse mix of guests. So you can have some that are just going to stay a single night. Maybe they're just passing through, going towards the Florida Panhandle. Okay, right there on I-10. So you got some that are staying for one night. You got others that maybe are working in the area, doing some construction work. They could be there for weeks or months at a time. And then there's people there that have actually chosen to make this park their permanent home. That's right. There are a lot of people now that are actually staying in RV parks, living there for years and years at a time. If you went, so whenever I bought this RV park in Biloxi, there's a whole section of just the permanent park residents back there, and I couldn't even really tell they were RVs because they look like mobile homes. They built porches on them. They built overhangs. They had flower beds. They had all kinds of stuff, a little fire pits out front. So it was really, really cool. So people, they'll do this for a year or two, maybe a little bit longer, decide they want to move, they pick up and leave. Okay. So in this Mississippi park, the revenue stream here is a lot more consistent versus the Montana park because it's not relying on a particular season, but it's spread out evenly throughout the year. So this diversity in tenant types creates a more stable and a more predictable income flow without those big sharp peaks like we talked about in the Montana park. Okay, so these two investment scenarios, they highlight the importance of understanding the market dynamics and the tenant profiles. In the seasonal park, your investment might hinge on the attractiveness of just a few peak months during the summer. On the other hand, the Mississippi park, they offers a more stable year-round returns, but without those high seasonal peaks. These examples underscore why it's essential to look beyond surface level attractiveness and considers how factors like seasonality and tenant diversity impact the investment's stability and predictability. So as you evaluate potential syndication deals, I want you to consider these nuances. You want to align your investment with your overall risk tolerance and your income preferences. Okay. And then something that we mentioned a little bit earlier, when you have just too many choices out there, you suffer from analysis paralysis. So if you have all these deals that are coming in, because I mean, as soon as you start to search online, you get your phone, what's going to happen? You're gonna start getting all these ads served to you, right? And all these different deals and RV parks, mobile home parks, self-storage, apartment syndications, all these different things that are going to be coming, and they're all going to look the same. And you're just going to like all these choices. Remember, having too many choices can paralyze you sometimes, okay? This is where many investors get stuck. And this is when they come to me and they're asking me for advice because they're bogged down in just the little minutia of each potential investment. But there are effective strategies to cut through this indecision, allow you to evaluate opportunities more efficiently, and more importantly, make smart choices. Okay, so if that is you and you're suffering from analysis paralysis, okay, first, it's essential, and we've talked about this a little bit before, it's essential to establish your own personal investment criteria. Everybody's different, okay? Just like the seasonal park in Montana or the one in Mississippi, okay? You have to establish your investment criteria. Think about this. What matters most to you, okay? What matters most to you? Again, RV park example, is it the stability? Does this matter more to you? The stability of year-round income, just like the Mississippi park, or that potential for that really high seasonal return with the Montana park? Maybe what's more important to you is the track record of the management team or the growth prospects of the particular location. Here's something that most people don't do. You have to sit down and you have to get a quiet air, and you have to think about, define, what does success look like for you in a real estate syndication deal. Now, if let's say you're just getting out of training and you're making a lot of money right now, so you don't need the distributions to live on. You don't need the monthly or quarterly distributions. Okay, you just want, hey, 5, 7, 10 years from now, I want to start getting these big checks coming in when all these things are doubling or tripling or whatever it is. That may be what success looks like for you. Or you may be in your late 40s, 50s, 60s, like, you know what, I'm phasing out of my practice, or I'm phasing out of my business or whatever. I'm wanting now some consistent revenue streams. I want monthly or quarterly. So again, you have to define what success looks like for you in each real estate syndication deal. Okay, then when you have these, then you take this criteria, okay, and then you're going to prioritize your list, okay? So not all investment factors are going to carry equal weight. So again, for some, the financial stability of a diverse tenant base may be important. For other people, it could be that thrill of a potential seasonal investment. Again, that may line more closely with your goals. So you want to make sure that you go in and you rank the criteria. Then you can just quickly sift through them. You start to sift through deals, again, focusing on what aligns with your investment philosophy. All right. Number 3, you want to trust your due diligence. Okay. Trust your due diligence. Once you've done your homework, you need to trust the process. It's very easy to second guess yourself. But remember, no investment is without risk. And if somebody tells you, hey, I've got this deal, there's no way you can lose money, don't walk, run, okay? Any investment, especially in real estate, there's always risk, okay? The key is to make informed decisions based on all this thorough research that we're talking about. And then once you do that, then you can start moving forward more confidently. Last but not least, you don't want to underestimate, this is something that I use a lot, and my wife knows about this, is because I have a pretty good BS meter. You want to never underestimate the power of your gut instinct. Never underestimate this, especially when it's informed by solid research and aligned with your criteria, okay? Because sometimes the best decisions come from a blend of data, but they also come from your intuition. Okay, so maybe you're looking at all this this deal. Let's say it's an RV park and everything looks great. Everything aligns, the location, the potential, the tenant profile, you've done all this stuff. Then you get on the phone and you talk to the general partner because you want to verify some things with track record. And you kind of just get this feeling like this, I don't know, I kind of get this thing in my gut. If you get that, make sure you don't underestimate that. I don't care about what all the property looks like, what all the numbers look like, what supposedly the reviews have said on their website. If you get that feeling, make sure you never underestimate it. All right. So now, armed with these strategies, hopefully now you're better equipped to navigate the world of syndication investments. So now I want to make sure that what we've given you will help you move past this analysis paralysis and more towards getting into investments. So if you're ready to start investing in deals and you're an accredited investor, I want you to make sure that you sign up for our investment group, Passive Investor Circle. I'll put the link again below in the description of this video. So what this allows you to do, you're allowed to invest alongside of me in deals that I'm personally investing in. I'm getting involved in. Okay, I'm seeking out the general partners. A lot of times they're making me what's called a co-general partner. I'm joining these groups, especially the ones that I really feel that are doing the best jobs because I have a process that I go through. Okay, so when you do this is a free group. You're able to start to network. We have over 2,500 members in it, and to get the best deal possible to get your overall goal, financial freedom. So again, if you're a credit investor, click the link below. Hope to see you in the group.